Hello my fellow investors and welcome back to another stock analysis video, and today we're going to be taking a recommendation from you guys. In fact, this one was brought up by Eric Scott 8 days ago where he says, "Thank you, can you cover SQM?" And also Luis Araya also said something similar where he said, "Thanks, waiting for SQM." He's 17% invested into this company. So here is the company website, guys. Right off the bat, very interesting because, well, this is in Spanish. So they are from Chile and they do some pretty cool things in my personal opinion. But we are going to cover that in this video, as well as look at their fundamentals and see if using discounted free cash flow, this is a pretty good buy today. So with that said, let's get started with this analysis. So guys, as I said, this company is from Chile and we got here what they do. Sociedad, Química y Minera de Chile, which means Society of Chemistry and Mine of Chile, produces and distributes specialty plant nutrients, iodine and its derivative, lithium and its derivatives, potassium chloride and sulfates, industrial chemicals, and other products and services. And again, if we come back over here, we got here Nutrición Vegetal de Especialidad, which means special vegetable nutrition. We got litio y derivados, which means lithium and derivatives. Yodo y derivados, which means iodine and derivatives. Potasio, which is potassium, and químicos industriales, which means industrial chemicals. So they pretty much do a bunch of cool stuff. They actually remind me of like APD, right? They remind me of Air Products Chemicals in a way. So that's pretty much what they do. They did have earnings on the 17th of November 2022. EPS normalized actual came in at $3.85, which was a beat by 53 cents. EPS gap actual $3.85, beat by 47 cents. Revenue actual $2.96 billion, which was a beat by $180.43 million. Now coming over here into the calculator, we got the ticker symbol for SQM, market cap of $22.2 billion, a PE of 7.77 with a current share price of $83.67. So this is looking like a pretty good buy as it currently stands, just based off of the PE. But again, companies are worth more than just the PE. Looking at the charts, guys, we got 1 year ago a 50.62% increase. That's insane. They've got a 50.62% in just 1 year. And so far today, from year to date, almost 9%. 52-week range is $49.80 to $115.76. So we're pretty much smack in the middle between these two numbers. They do pay out a dividend of $8.93, which is a massive yield. Oh dear Lord, that is a massive yield of 10.67%, a payout ratio of 43.93%, a 5-year CAGR of 37.59% with 0 consecutive years of dividend payment. Now that 0 consecutive years of dividend payment is a little bit of a red flag. So if we take a look over here at the dividend history, we can see that, well, they actually used to pay it, guys, semi-annually. However, as of September 4th, 2019, they actually started to putting it out on a quarterly basis. But by the looks of it, guys, they did have a little bit of a hiatus here in 2021, where at the beginning of 2021, they never issued a dividend. And the first issued was in June 2nd, 2021, then again on September 1st, 2021, and the last one that they did that year was on December 30th, 2021. Then they brought it down to 10 cents on April 27, 2022, brought it up to $2.60 in June 1st, 2022, brought it down to $1.85 in September 28, 2022, and they brought it back up to $2.97 in December 7th, 2022. So this is all over the place when it comes to dividend. It's not really, I wouldn't say it's not really that reliable, because I mean, they did have a small hiatus at the beginning of 2021. But nonetheless, that's still a massive yield of 10.6%. Ex-dividend date passed as of December 8th. Payout date was December 27th, and they pay their dividends quarterly. Now, based off of the current shares outstanding and this $8.93 in annual dividends per share, they pay out $2.55 billion every single year. And in regards to their 5-year average free cash flow, after this is paid out, they're left with, well, unfortunately, negative $2 billion. And as of their last year's free cash flow, it is still in the negative by negative $8.51 million. These payout ratio, guys, are massive. 100.33% for the last year's free cash flow and 405.41% for the 5-year average. So in both scenarios, they are taking on debt. Now, this could be a little bit misleading because some companies, at least I don't know how they do it in Chile, but at least in the United States, most companies issue a dividend based off of their cash flow. Cash flow is what companies use to pay out the dividend. I don't necessarily know about Chile, so if anybody could tell me in the comment section below what aspect they use to pay out this dividend, that would be great. But as it currently stands, taking it from a US perspective, they are 100% taking on debt to pay out this dividend. Now coming into the fundamentals, this one is going to be fun. Starting of course with a net income 5 years ago of $440 million, 1 year ago of $3.1 billion, increase of 600%. We see the net income roughly at around like the $400 million mark on average from 5 to 2 years ago. They dipped during COVID 3 years ago to $164.5 million, but overall roughly at around like the $400 million mark or so on average. And then last year they just skyrocketed to $3.1 billion. So we're going to see this a lot when it comes to these profit metrics. And I do not like outliers like this, guys. I really do not. As it currently stands, guys, this is just, I don't know, this is very, very weird. I have to give this like a 30%, I guess. I mean, you know, constant decrease from 5 to 3 years ago. They jumped after COVID to 585, but then it's a spiked from $585.5 million 2 years ago to $3.1 billion. I do not like that at all, so I'm going to give it 30%. We see the exact same thing when it comes to the free cash flow. Actually, this one's worse because 5 years ago it was $280.1 million to 1 year ago of $2.5 billion. Increase of 807% with an average of $629.1 million. The reason why I'm saying this is worse than that of the net income is 3 years ago during COVID, they went negative $140 million. But I'm going to give them the benefit of the doubt on this one, guys. This was due to COVID. I'm not going to ding them on this. It's just, it really is unfair. But as you can clearly see, the average is not anything even remotely close to $500 million in the free cash flow, right? It's roughly like at the $200 million mark, maybe $250. Guys, they went from $358 million 2 years ago to $2.54 billion. That is a massive increase, okay? Like insane. Now, again, same exact reasons as the net income. I do not like that spike, so I'm going to give it a 30%. I'm not dinging this because of the negative free cash flow. It's just that massive outlier is just really, really prominent. And we see this once again in the revenue 5 years ago of $2.3 billion to 1 year ago of $8.66 billion, increase of 282.26%. Very, very similar to that, guys, of the net income, where you see consistent decrease from 5 to 3 years ago. Obviously, 3 years ago was COVID. They jumped up a little bit 2 years ago to $2.86 billion, and then from $2.86 billion, $8.66 billion. Yeah, I'm gonna have to give this once again like a 30%. Looking now at the total assets minus the total liabilities, currently they're actually doing fairly good. $4.645 billion. Now, this is an outlier, but to be fair, it's not a big outlier, right? I mean, 1 year ago they did $3.2 billion, and their average from 5 to 2 years ago, it is around like $2 billion or so. I mean, it is a big outlier, but honestly, it's like compared to like these ones, this is like nothing. This is like normal. Average total assets is $6.2 billion. Average liabilities is $3.35 billion. And doing this difference, we get $2.86 billion. I'm going to give this one a 70%, mainly because it has been positive in the past 5 years. And yes, again, it is a pretty big jump 1 year ago and today, but it really isn't as bad as the other one, so I think it's pretty fair for me to give it like a 70%. Into the cash flow minus the total liabilities, we got this one is looking interesting because, well, from 5 to 3 years ago, consistent decrease, and then from 3 to 1 year ago, consistent increase. So as of 1 year ago, they're at negative $1.29 billion. And 2 years ago, it was negative $2.3 billion. And the lowest point was 3 years ago during COVID, which again, I'm not faulting them for this, at negative $2.7 billion. The fact that they have consistently brought this up from 3 to 2 to 1 year ago, I like it. It's pretty good. Average cash flow minus the average total liabilities, we get negative $2 billion. I'm going to give this like a 65%. Now coming into the silent killer when it comes to investing, guys, and that is the shares outstanding. This one is very, very interesting. Unfortunately, it is an increase on the 5 year, but take a look at this, guys. 5 years ago to 263.2 million shares to today of 285.6 million shares. Reason why I'm saying this is interesting is because they have kept it the same from 5 to 2 years ago, 263.2 million shares. Only last year is when they increased it to to 285.6 million shares. So they do have a tendency to actually keep shares the same, which is still a good thing, right? It's either keeping it the same or buying back. That's it. If they issue, that doesn't necessarily mean that it's bad, but you have to take a look as to why they're issuing. The fact that they issued just last year and it was only by around like 8.51% tells me that they probably did like an acquisition somewhere. So definitely take a look at that when it comes into this company if you're interested in this company right now. But the fact that they did this, I think they issued share because they made an acquisition. I'm going to give this like a 90%. And lastly, when it comes to the cash and equivalents, they currently hold $3.51 billion with an average of $1.22 billion. Now, when it comes to the overall grade, I gave the net income 30%, free cash flow 30%, revenue 30%, assets minus liabilities 70%, cash flow minus liabilities 65%, shares outstanding 90%, for an overall grade of 47%. My biggest issue here, guys, is these profit metrics. And the main thing is just that it's just a spike. It's that last year's numbers is just a massive outlier. And I do not like that because I do not know if they're going to continue to do this into the future. That's the problem, is the uncertainty that it comes with massive spikes like that out of nowhere. For all you know, next year's net income might fall from 3 billion to now like $1 billion or something, right? That's a massive drop. So that's the reason why I give it 30%. Honestly, if there was an explanation for it, like a reasonable explanation, and or if they are able to continue it into the future, then obviously this would be a much higher grade. But that's the reason why I'm giving them a 30% for an overall grade of 47%. So now with that said, let's actually see if at the current share price of $83.67, this is looking like a buy. Now, let's make some assumptions, guys, of revenue growth, projected share buyback, and a required rate of return of 10%. But before we do that, take a look at this. Now the target share prices with no numbers put into this, just the required rate of return. The target share price, it is $24 and a penny, not adjusting for debt. And adjusting for debt, it comes up to $60.30, which is again actually fairly good, seeing that they apparently have a lot more cash on hand than they do net debt, which is, you know, really good to see. Now let's come over here to Seeking Alpha and see that the forward is estimated at 83.1%. I do not believe that. Okay, I'm sorry, but I'm not going to put anywhere near 83%. I'm gonna go something a lot more, I guess, conservative and more logical in my personal opinion. I'm gonna go with 5, 6, and 7% when it comes to this. And then for the projected share buyback, honestly, I get that they have been issuing at least within the past year or so, but I don't think that they'll do that in the future. I really don't think that they'll do that in the future. I really don't. They might actually start buying back fairly soon. So I'm going to go with 0 because they have instances where they have done 0. Let's go with 2 and let us go with 4%. Now with that, we get the target share prices, not adjusting for debt, of $28.64 to almost $32, and then adjusting for debt, $69.55 to $76.64. With a margin of safety of 5, 10, 15%, this puts me between $59.12 to $72.81. So as it currently stands, well, not adjusting for debt, this is looking like not a buy right now. However, adjusting for debt, it's still not looking like a buy, but it is still fairly close to that target share price. And to be fair, from $76.64 to $83, that is what, like a $7 difference or so? Yeah, that might be the premium that you might be willing to pay. Again, assuming that you believe my assumptions. Because at the end of the day, guys, you guys saw me input all of these numbers in here, and you saw that the numbers change pretty drastically. Every investment is the present value of all future cash flow, and this is not financial advice. This is why I have all of this for free, because I want everybody to be making their own assumptions when it comes to the companies that they choose. Whenever you guys ask me for an analysis on them, I'm not going to go in depth into any company. I just don't have the time to do that. What I'm going to do is I'm going to give you guys my opinion based off of the surface level stuff. Obviously, if you know something more about a certain company, then by all means, you guys can have these calculators and add that into your assumptions. I have this one, the book value one, the reevaluation one, and a dividend tracking sheet for everybody to have. So that way, if you guys do know something, let's just say you believe this company might be able to do some pretty cool innovative stuff in the future, or maybe you know why those outliers are like that, and you believe that those outliers will continue to be going in the several $billion into the future, you know, you might put revenue growths of like, let's say around 10, 12, and 14%. Well, at that point, now the numbers change drastically, right? So again, it all just depends as to what you believe and what you know based off of the knowledge that you know for a company. And this involves any company, by the way. It's not just this one. Please make sure you do your own due diligence before investing your money, because you can lose it all. All I'm doing is, guys, providing you the tools in order to do that. That's why, again, all of these calculators are for free. All I'm asking for in return is just help me grow my channel. Like, subscribe, comment. It really does help her with the algorithm on YouTube. Thank you so much for the 1,800 plus subscribers. Absolutely crazy. Dear Lord. And we're not even in February yet. Actually, we're not even halfway through January as if I'm recording this. It's only the 14th. So it's just amazing that, you know, you guys have helped me grow so much. I really do appreciate it. To everybody who regularly comments, to all the lurkers, to people who like, you know, I thank you all so much. I really do appreciate it. I don't plan on ever having any sponsorships here, guys. The best way that you can help me is just like, subscribe, comment, and of course, share. And now that I have fixed that share price, for some reason it went NA on Google spreadsheets because Google Finance apparently just doesn't want to work today. We got over here, guys, the dividends at the current share price. This is a massive yield. Annual dividends per share of $8.93. As you guys remember, it was like a 10.67% yield. Absolutely massive. So we got here the monthly income, $5,725. We put in this amount of money. This buys us 68.43 shares. At this annual dividends per share, dear God, this becomes $611.05. $611.05. What? That's insane. That's insane. Quarterly dividends of $152.76 and a monthly of almost $51. But again, the issue when it came to this dividends is, for starters, the cash flow in regards to this dividend, it's very, very high. In fact, they're in the negative. That means that they cannot afford to pay out this dividend based off of their free cash flow. Again, if this company pays that dividend in regards to another aspect of their profit metrics, then please let me know in the comment section below. For example, Zim puts out their dividend based off of a 30% in their net income. That's different than what companies usually do. Companies usually do it, again, in regards to their free cash flow. So I'm basing this off of that. If that's not the case, then please let me know in the comment section below. But as it currently stands, for some reason, this just went NA. And now that we're finally back with that, yeah, if you guys know anything about how this dividend is distributed, then fine, leave in the comment section below. Or if not really a bother to you, then by all means do it. But understand that you might get a significant hit to this dividend if they decide to cut it, because the chances of them cutting it based off of these numbers is very likely. All in all, thank you so much for this recommendation. I really do hope it was helpful. I'm sorry that it wasn't as positive as I would think you guys would like it, but then again, this is from Chile. I'm not certain exactly how these kinds of companies operate in Chile, right? I'm basing my knowledge off of US kind of companies, right? Off of like APD and that kind of stuff. So if you guys know anything else about this company that might change some numbers, then again, have these calculators and use that knowledge that you have to see what numbers you get. But from my end, that's essentially my 2 cents. That pretty much does it for this video. I like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my new tech sites and link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video.